Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Andrew Maguire. Now, most of you no doubt know Andrew, know of him at least, but his bio is so remarkable. So for the sake of those of you who may not be that familiar with me, let me tell you that in 2009, Andrew decided to go public and provide evidence to the U.S. regulators relating to fraud and price manipulation in the gold and silver markets. And that put Andrew at the epicenter of a storm for exposing what could be the largest fraud in history involving countries, banks, and government leaders. Indeed, just recently, Deutsche Bank admitted to price manipulation in the silver market, I believe it was, and they are paying $38 million to some people who have sued them for price manipulation. But with that, a huge number of emails were released along with the fine. Emails, or at least discussions between traders who colluded to fix prices. Also, audio files have been released as well, according to a report that I saw on Bloomberg the other day. So this is getting really interesting, and I guess a lot of people may be looking to some of that information for future lawsuits as well. Andrew is actually currently advising various law firms who are involved in bringing justice to these criminal acts against these people that have wronged others in trade. And he sits on the advisory board of the Allocated Bullion Exchange and is a consultant and advisor to many international hedge fund managers, bullion banks, directors, and metal traders globally, all of whom rely on his highly recognized field of expert market analysis and incredibly accurate ability to forecast. Thanks for joining me again, Andrew.
Oh, it's a pleasure to be with you, Jay.
Always good to have you with me, and I want to mention that a website where people can go to learn more about what you're all about, I believe. Correct me if I'm wrong, but I believe it's just simply Andrew Maguire, goldtrading.com, right?
That is correct. Yes, Jay.
All right. Well, interestingly enough, the settlement that Deutsche Bank just recently made, $38 million, and that, I guess, was here in New York where that took place. And I see that in addition to the payment, to the fine, they were required to release some 350,000 pages of documents and 75 audio tapes, according to Bloomberg Television, and they reported on this the other day. And it really showed that, in this case, I guess it was Deutsche Bank and UBS. UBS was involved somehow. I guess the different traders were colluding and fixing the price. Deutsche Bank, I think, but also, in addition to Deutsche Bank and UBS, Barclays Bank and HSBC were named as possible banks that were involved in this mess as well. What can you tell us about what's your read of this, and how important is this $38 million fine? Because it seems to me that's sort of chump change for the big boys, for these big banks, and no one's going to jail. It just seems like it's kind of the same old, where banks do criminal acts and they get off scot-free. That's kind of a cost of doing business for them, it would seem.
Yeah, absolutely. And I think in this case, though, I think that we have going to get a bit of traction. I think this discovery process was pretty much unprecedented. No one was expecting to be able to get discovery on these banks. And lifting that lid, it really does expose an enormous rabbit warren of collusion. Now, Deutsche Bank did a deal with the regulators and essentially got immunity from official action. But I mean, really, as far as the civil suits are concerned, they're wide open. And so Deutsche Bank threw all the other buses under all the other banks under the bus. Uh-huh. And really to get that that sort of protection from the regulatory charges. But these thousands of documents really are just the tip of the iceberg. What we're seeing here is really just a tiny fraction of what I gave to the regulators over 5 years ago, uh-huh. and at a time when, especially in the silver market, where they came back and said that they could find no evidence. Now, but here's the amusing part. Just think about how brazen these traders were, willing to share jailable, collusive statements amongst each other, texts, phone calls amongst each other. It just shows you how immune they felt from any kind of pursuit. And but Jay, these are just the fools who got caught. What about the well-organized traders who were, and I'm talking about the biggest trading banks here that everyone knows, who were, and they continue, these guys continue to be more careful. I mean, they don't trade, they don't put anything down in writing. These guys meet and have done for many, many years, and we know that, and that's part of the evidence I gave, and where they meet, and how they discuss these things, and how they communicate. Now, these are just the fools who got caught. Just wait until the finger pointing starts, though, because you can just imagine these individual traders. Now, when the regulators reached a point where how can they not act? I mean, we're talking about laws that have been broken, jailable offences, and so really someone's going to need to get charged here at some point. Even if they start to concentrate on the individual traders, then you can bet your life they'll try and seek some sort of deal, some sort of pleading situation where they'll just literally point the fingers at the other banks and the traders that they know are acting, and even those that were not part of this these email chains and these telephone calls. But there's a lot more to come out. So I think this is going to end up, to answer your question, where's this going to go? Well, it's going to ultimately, this could cost not just billions. When you consider that there are derivatives involved of the gold price, and you imagine that there are producers here who over the last decade alone have been forced by their financing bullion banks, who are the same guys who have been trading against these guys, forced to sell or forward sell to obtain financing based upon a price that's been rigged against them. Now, these guys, any good lawyer is going to come back and say, well, hold on a minute, look, not only have we lost this, but we've also, what about the derivative exposure we've been exposed to? And the lawsuits that are going to come out cannot be stopped. This is going to, I probably end up with banking licenses being pulled.
Wow, that's pretty remarkable. I mean, when you think of it, so you think maybe some of the big mining companies, I mean, you think about some of these huge mining companies that have been forced to sell their product at prices that are artificially low, but how would you ever be able to know how much lower they are than the market price would be, given this ongoing manipulation that's gone on for year after year, decade after decade, essentially?
Yeah, and I think, and again, here's the issue. Do you go up, if you owe your bank money, do you go up and blow the whistle on him, knowing he can pull your mortgage, pull your account? Of course. So the key thing here is that for these producers to come out of the woodwork, what they need to do is have alternate financing in place, and I think that is one of the things that we're working on with the allocated bullion exchange. And that's one of the benefits, an institutional benefit, where we're organizing financing situations that operate outside the legacy banking system as we know it, as you know, I mean, when we come to the fixes, and these lawsuits relate to the fixes, but there are many, many other cases where simply it's not just the fixes that we're being colluded on. It's sort of targeted levels where stops were visible. It doesn't necessarily have to relate directly to a fix, although this case relates to that. But essentially, these when you're a producer, and your financing bank of maybe half a dozen financing banks that are really big in the business, and they then throw your product in at market into a fix that has been groomed lower, and so forget all the lawsuits about what money's been lost. But essentially, it's left these producers being literally forced to literally eat the price that they were given, and yet there's only 5 to 7 tons of producer sales hitting the LBMA, the global bullion markets in London every day. Yet there is a huge amount more volume now being transacted outside the legacy system. And what we're seeing is liquidity being sucked out of this old legacy system into a much more liquid physical banking, physical marketplace where financing is becoming available to producers outside of the legacy system. So I think big changes happening in 2017.
All right. So you're talking about the Shanghai exchange, and I guess maybe there's some others over in Asia where they are literally a 100% bullion exchange, right?
Well, exactly. And if you want to trade, for example, SGE, for example, or the allocated bullion exchange that I advise for, I mean, you literally, if you want to trade, you have to have a bullion in place before you sell it, and you have to. And when you're a buyer, it's T+0. You own it. So you know the games cease right at the source. Now, if you can't add synthetic amounts of gold that you're not prepared to deliver or have not already delivered into the exchange. So big difference to what we're seeing. So. You mentioned premiums. I mean, the SGE fix is now front running the AM London fix, and we're seeing currently seeing a very large positive arbitrage effect influencing and dragging London spot up. Now, we see the spread narrowing, and people say, yeah, but look, the price is collapsing. Price would be a lot lower if this was not the case. Now, Jay, we're witnessing consistent SGE premiums over London spot of between $30 and $35 per day. Now, So let's think about that for 1 second. So over the last 2 weeks, we've evidenced these consistent, and we're not talking about 1 day here and a day there, consistent premiums over London spot of between $30 and $35. Now, last Thursday, this is a bit of insight because I'm obviously in the wholesale business. Last Thursday, I reported a 55-ton gold delivery into the SGE from our refiner at a $36 premium to the prior day's Wednesday's GLD closing price. Now, again, on the next day on Friday, I reported a similar large direct from refiner sale to the SGE. Now, these transactions are just what I'm aware of, and they reflect over 100 tons between Thursday and Friday of last week. Now, what they reflect is under-the-radar flows from other sources, and this illustrates how widely disseminated rumors of China restricting gold import licenses are not as dramatic as spun. Now, if there are import license restrictions, these orders are quite clearly being fulfilled by some of the other 15 licensed importers. But, I mean, really, you know, if you're talking, just imagine for 1 second, 50 tons at $30 above spot, even accounting for the refining from 995 purity to 49s purity, even accounting for that cost, that's $45 million profit.
Right.
That's a huge incentive for some of the LBMA bullion banks to break rank, scoop up all the officially driven low-priced unallocated gold they can. And we've seen this on every past occasion. And so this time we're not seeing $50 premiums like we saw in 2013 when we hit the lows, but by crikey, Jay, we're looking at a situation here where it's pretty obvious that the paper and the physical markets are bifurcated to a big degree.
Well, I would think, Andrew, that the fiduciary responsibility of the CEOs of these mining companies would require them then to deliver their gold into the let's say their unencumbered gold, the gold that they have not already committed to pay back their gold loans or whatever, that they would be required almost ethically to sell into the Asian markets.
Absolutely, and then so now we're talking just China. But now we're looking at, if we just turn for 1 second to the international facing exchanges that are pure physical, that require you to put the physical up front, or a producer to lodge the physical before it's sold. Now, you just factor the effect. And of course, I'm talking about the allocated bullion exchange, and the effect that is going to have on the paper markets. Now, I'm going to leave the upcoming hard launch because that's big news for the gold industry. And I'm going to leave that to Tom, the CEO, to talk to you about on your program in the early new year. But Jay, this is a game changer. And it's going to break up the monopoly of the current actors that their current actors have in the precious metals markets. Now, the key thing about this, and I know that you have plenty of guests who have talked about retail solutions, which are brilliant, fantastic to see retail gold, silver being available to people on a retail level, making life easy for people to purchase this, and it leaches fractional reserve gold out of the hands of the controlling LBMA banks. But an institutional solution, and I'm talking about where a producer can swap his gold from one location to another through a centrally cleared exchange, and never been heard of, and it's not in existence today, and it only since the launch of the allocated bullion exchange and the hard launch that's coming up that we're going to see a major change in the way gold is traded in the future.
All right, so is the allocated bullion exchange then going to be marketing its services to the big mining companies, perhaps, so that they're very much aware of the premium they can get by selling into the Asian markets?
Yeah, and we estimate up to $25 an ounce premiums based upon the lack of friction that they receive through their current legacy system, and I mean that is a huge incentive. And of course, its key thing is the financing process as well. You're not going to go to your banker and say, "I want to take a bit of my business away." They'll say, "Right, we don't want any of your business." So again, it's all part of this process, and it's part of the process of what Tom was talking about on the hard launch, where although we are soft launch, the hard launch is coming, and I think this is what's going to change the industry from an institutional level.
When is that scheduled?
I think when Tom will give you the exact deadline when he comes. I know that we're scheduled in January.
Yes,
early January. So I'll leave let him. I'll leave him the thunder.
Okay. Well, it seems to me that if gold is not any longer going to the LBMA or COMEX or wherever these sort of fraudulent fake paper market exchanges, that if they are absent gold completely, at what point then does that really expose them for the fraud that they've been?
Well, I think this is the point is that with the trillions of dollars of derivative bets that appear to be offside, that are quite clearly offside, that have been accrued over the last at least 10 to 15 years, I don't see any backdoor for that. So I can't see any other way other than a paper price reset. There is no other solution. And that just simply means someone at one weekend is going to close the market, reopen it at a different price. Anyone who's not got physical, anyone who's in the unallocated paper markets will be settled for cash on the prior close. It'll open up at another price. And Jay, God knows what that is. I couldn't even guess what that real price is.
Yeah, it's impossible to know, of course, but it just strikes me that a lot of these people are buying ETFs or whatever. They're buying paper derivatives of the gold, thinking they actually own gold, don't they? I mean, they actually think they own gold. The people that are buying GLD and things like that.
They actually believe they own gold, and they don't realize that it's possible to double own that, to short it. They don't understand that at all. Otherwise, they wouldn't be in it.
So when that day comes, it's going to be Katie bar the door, and as you say, it's impossible to know what price it will be. I think it's fair to say it's not going to be lower, though, from these levels.
Absolutely not. And where are we? December the 3rd, 2015, and December the 17th, 2015 is where we made the lows. What we're heading for is a rate hike tomorrow. Yeah, a face-saving rate hike. We had the same thing last year. Sell the news event. A big rally coming.
Yeah, I wouldn't be surprised at all. What do you make of what's going on with 3 minutes left here in India? With Modi making it illegal to own paper money even. Are Indians scrambling for gold now? And if that's the case, might he not try to make that illegal and throw all the paupers in jail?
Well, yeah, and you can shut down the official market. This black market in India is enormous, and what this has done, these capital controls, what they've done is essentially made every single Indian now not trust any official banknotes. They will never trust an Indian banknote again. And this experiment's backfiring badly. But I think that this is part of a central plan, trial balloon. Try it out in India, see what happens. It's backfiring. The smuggling, the black money, we say black money, it's just the money that's avoiding tax, is moving into the unallocated market. We're seeing 20, well, the World Gold Council says 20 to 30 tons a month of smuggled gold. We're seeing that expand to 40 to 45 tons a month with the amount of money that's being now attracted to the black market. Simply, that wasn't even there before. People are avoiding scrutiny.
All right. Well, I did ask you a couple of weeks ago before the election, actually. I said, are we going to hold 1,200, and if we don't, what then? And your answer was, I don't think we're going to go below 1,200, but if we do, it's going to be very brief. So how do you define very brief?
Well, I think that we've reached a point where we're so synthetically oversold versus the physical market, with the premiums are telling us that this is an overextended flush of hot money that needed to be rinsed out. And I see us moving after FOMC. I see us starting a huge rally. We're going to have a very volatile FOMC day, but I then see us retaking the 1,200s, the 1,300s as we move into 2017.
Well, we'll leave it there on that optimistic note. Thank you very much, Andrew, for being with us again. And we do want to revisit the allocated bullion exchange story. That looks like a very important one, and so we'll look to talk to you and Tom sometime early in 2017. Thanks again for being with us today.